Why are we rallying, Court? Because money, as Bank of America says today, the bulls are alive. Cash now is at lowest levels since March 2013. This long-awaited money is coming off the sidelines, and it's going into equities.
It absolutely is going into equities. At Loop Capital, we're seeing that flow, and we're seeing it not just in the U.S., where we have seen those rallies so far this year. We are seeing it globally. I mean, we're seeing tremendous buying in Japan. You talked about the Nikkei being up. We're seeing tremendous buying in Europe as well. I mean, you saw what happened, you talked about financials, Joe, with Deutsche Bank. I mean, they came in, they looked at that plan, they're like, hey, these guys are turning the ship properly. So I think we're seeing some global growth, and that's what we've been looking to see here, this rally coming around globally. We're seeing it across sectors and across the globe at this point.
All right, Steph, so where's the money going? Money's going into Nike, all-time high back to the IPO in 1980, going into Lowe's, all-time high back to the IPO in October of 1961. It's going into Marriott, it's going into Alphabet, it's going into Apple, it's going into Allergan, it's going into Amgen, it's going into Goldman.
What did I just say to you, Scott? What did I just give you? There you go.
You own all those,
Take a shot and you're making them all.
There's a lot of new highs.
Absolutely.
Right? So the money is going into a lot of diverse places within the market in a lot of different sectors.
And that's very healthy, right? It's very broad-based. That's what you want to see. Absolutely. We've gotten through a lot of unknowns in terms of trade and Brexit and the Fed and the budget. And I've said before, I think we are priced at this multiple at about 18 times. We are pricing in a lot of good news. However, I do think now we shift to growth and global growth, like Kourtney was just talking about. And that's why the money is going globally, because you are starting to see better growth. It's not great, but it's improving. And by the way, the data points today that we got here in the States was actually very encouraging with regards to housing, industrial production. And I know industrial production was benefited from the GM strike coming back. But I do think you're seeing business capex within industrial production actually show an improvement. So that's encouraging.
Hey, to your point, and speaking of encouraging, sorry to jump in, the fourth quarter GDP a few weeks ago was expected to be pretty lousy. Now, it's tracking, the average forecast is now at 1.9%.
Right. So you're probably going to do 1.9, 2% in 4Q, but I'm actually more so looking 2020. And I'm thinking that if the ISMs and PMIs globally have bottomed, that we're actually going to see an acceleration in 2020. And therefore, you're going to see earnings. I thought you'd see better earnings by the fourth quarter of this year. I think you're going to see better earnings in 2020, related, especially on easy comps, by the way. So I think that's important. You have to have earnings growth because we've already had multiple expansion, because I don't expect to see a lot of multiple expansion in 2020. So where am I going? I mean, I am going into a couple of those names that you talked about, but I'm looking at, I took profits in D.R. Horton today, right? And I'm actually putting it into Home Depot because it's still down 10%. I'm looking at NVIDIA. NVIDIA, actually, I've never been involved in that name, and actually I added that last week. It's still down 20% from its high. Schwab, that's an opportunity because of the M&A that they're doing. So I'm looking for pieces in the market that aren't at all-time highs, because that's where I actually see value.
Absolutely.
How do you see things now, Rob? Somebody who was, I guess, somewhat cautious, maybe has gotten a little more adventurous, gotten some of the headwinds out of the way, right?
Yeah,
Trade deal tensions have eased a bit. Fed meetings behind us. Runway seems pretty good.
It does. I think I like the way Joe's playing. It kind of focused on the laggards because it's a little tough to chase everything that's fully priced in the U.S. I think that's really hard. And one of the things that we've done is we've taken a little out of fixed income and we've added to emerging markets. As you know, emerging markets has been a big laggard relative to developed markets. Valuations are cheap there. I think that, we could enter, though, the point on multiple expansion. I think that's possible in this interest rate environment, especially if you get into a super Goldilocks scenario. And by that, I mean you have growth reaccelerate without inflation. The Fed has been clear. What they're focused on is inflation.
So if you get growth, multiple expansion already, I think that's
you have
at the heart of Stephanie's point.
Yeah.
But you got that for one very important reason. We entered the year expecting the Fed to hike rates, and we got 3 cuts. That is a very different environment. So you had an enormous tailwind with a lot of headline risk on the dashboard that didn't play out. So as those negatives were removed, markets accelerated. That was the reason that to be cautious was the headlines, and to be optimistic was the fundamentals in the Fed.
You don't really think that if earnings are a disappointment, that the market is sustainable to go up, do you?
Earnings just have to come in.
You have to have some good earnings growth now.
No, you have to have better than feared earnings. Right? That's what you need. And that's what we had in the third quarter. And if you go into next year and you get 5% earnings growth, I think that could be fine when you have these other catalyzers there. Where I worry is as you get later in the year and comps get more difficult and you get into the kind of election cycle and you get into the possible regulatory environment where you could see financials getting regulated again, healthcare, whatever, technology even, right? I think that's where risk can manifest itself. But right now, I think it's a little safer to go in. The other thing that I would mention is last year was very precarious because there was a lot of opportunity for tax loss selling. This year, everything's up. You threw the paper at us. There's nothing that's down. Really, maybe MLPs have given some back, and there's an opportunity to take some losses there versus these gains, but there's no places to take losses. Then when you get into next year and you think, if I'm a capital allocator, where do I allocate money? Well, there's really no alternative to stocks. It's really hard.